In today's video, I want to dispel two common myths that cause many buyers or potential home buyers to sit on the sidelines much longer than they need to and prevents them from buying a home unnecessarily. Hi, this is Andrew with the Andrew Smith team at eXp Realty, and I've come across this so many times in the past, and it's still prevalent with some of the people that I've spoken to over the past few months. And myth number one has to do with the amount of the down payment. The idea that a 20% down payment is needed in order to obtain a mortgage or buy a home. Myth number two, which goes right along with it, has to do with FICO scores and the belief that your credit score needs to be much higher than it actually does in order to qualify for a home loan. So I'm going to discuss both of those kind of together because they do go together, credit scores along with down payment amounts. What is not realized is that 20% is not needed to buy a home. In fact, it's not even the most common down payment used over the past few years. Now, with that in mind, it can cause many to turn around and say, well, oh my gosh, isn't that going to create a huge mortgage problem? That's what got us into trouble last time. All of these people that couldn't qualify and they were able to buy homes with no money down. And the answer to that is no. This is nothing like the mortgage payments or the mortgage programs, I should say, that were done before. Those mortgage programs, in many cases, they were known as liar loans. Fog a mirror, sign here, get a loan. There was no verification. There wasn't really much qualification needed at all. That is not the case today. Those loans are gone. They don't exist anymore. And when those changes in the mortgage industry took place, it left many potential buyers assuming that they needed much more money down than they actually do. The difference now is that you do actually have to qualify for a loan. They are going to verify your credit. They are going to check your assets. They are going to check your income. And they're going to look at those ratios of debt to income, which they didn't always do all those years ago when we had the problem. So when we look at down payment first, there are basically two different types of common loan programs out there that allow you to buy with substantially less than 20% down. There's an FHA loan. An FHA is not just for first-time home buyers. Anyone can qualify for an FHA loan as long as you haven't got an existing one in place currently or used one fairly recently. An FHA loan will let you buy for as little as 3.5% down. So 3.5% of the purchase price is what's required for your down payment. On a conventional, they will actually allow you to purchase for 3% down. Okay, so it used to be that the conventional had a higher down payment, and that's not the case. The conventional loan programs came out with a lower down payment basically as competition to the FHA. So on a conventional loan, you can put as little as 3% down, you can put 5% down, you can do 10% down, or you can do a standard 20% or more down. So which one's better or which one's right for you? And that honestly depends on your particular situation, how strong your credit is, what area you're buying in, what prices are, and what it actually is that you're looking for. So in general, just a quick run through on some comparisons between these. FHA loans are great for anybody with low to average credit. You can actually get an FHA loan for a credit score that goes all the way down to 580. So you can actually have a 580 credit score with a job and good income and qualify for an FHA loan. In order to go with a conventional route and 3% down, you are going to need a little bit more of a more of a down payment. You are going to need a better credit score. Somewhere in the mid to high 600s is going to be required. So does that surprise you? Are those credit scores required to get into those loans a lot lower than you thought they would be? Chances are they are, because many people think they need a credit score somewhere in the mid 700s, and that's just not the case. So If we do just a quick comparison between some of them, as I already mentioned, the minimum down payment for the conventional is 3%, 3.5% for an FHA. The minimum credit score required for the 3% down conventional is 620, and it's 580 for the FHA loan. Here's where you start to get into some other differences. Debt to income ratio. The maximum debt to income ratio for the conventional is 43%. Whereas on the FHA, they will allow your debt to income ratio to go as high as 50%. Now, the loan limits are different. For conventional, in general, you can go up to $510,400 on the loan limit, not the purchase price, but the loan limit. And depending upon where you are, $331,760 is a fairly common FHA limit, although it is higher in some areas where the cost of homes is also higher. One thing to keep in mind is mortgage insurance. So there is a difference, and anytime you have less than 20% down, mortgage insurance is going to be required. And the private mortgage insurance is a little bit different in how it's calculated and how long you have to have it, depending upon these two different loan types. So with a conventional loan, the private mortgage insurance is going to be charged as a percentage, anything up to 2.25% of the loan amount divided over the loan term, and that's added to your monthly payment. That stays in place until the equity you have in the home reaches 20%. Okay, so if you put 3% down, and you're paying that down and home prices are going up over the next 2, 3, 4 years, there will come a time when your loan to value will reach that 80% mark, and you can have that PMI removed. On an FHA loan, it's a little bit different. There's a mortgage insurance premium that's charged up front, usually about 1.75%, and then it usually runs about 0.85% of the loan amount. The difference is it doesn't fall off at the 80% loan to value like it does on conventional financing. If you put less than 10% down, that mortgage insurance is going to be there for the first 11 years. On the other hand, if you put down 3.5% up to 10%, so basically anything less than 10%, then that mortgage insurance is going to be there for the life of the loan, regardless of what the loan to value becomes. So that's something to keep in mind between the two. Which option is best for you? That's something to talk to your lender about. So if you've been sitting on the fence and thinking you don't have enough money or your credit is not good enough to buy, interest rates right now are phenomenal. I mean, right as I'm recording this, they're in the very low threes. Unheard of. They're at historic lows. So your ability to qualify is usually much higher than many potential buyers think it is. So get with a mortgage lender, go over the options and get pre-approved, especially in today's market. Competition out there is fierce. Supply is generally low in most areas, and there's a lot of buyer activity out there. So you want to make sure that you get that pre-approval. A lender is going to help you do that and go through all of these different loan programs with you to find the one that fits you and your situation the best. Hopefully that's helped you a little bit, dispel a couple of those myths with regards to credit score and down payment required. If you've got questions about your specific situation, please feel free to reach out. My contact information is directly below, and I'm always happy to help however I can.